What's up, guys? Today I'm going to be going over the importance of equal highs and equal lows inside the market. So let's first start off with a basic understanding of liquidity. Liquidity is resting orders, and resting orders rest at the top of highs and lows. So taking that knowledge, we think of one high. Let's just mark our liquidity out with a dollar sign, our resting orders with a dollar sign. So when we create an equal high, what they look like is just a equal high. Um, we are building up more orders. So let's just draw another dollar sign right here to show that there's more orders being built up in the same area of price. Um, Another great way to think of it is this one high as a magnet and this high is another magnet. When you combine these two magnets together, you have two magnets now. Price is going to attract towards these even more because there's an extra magnet. Um, so then what you're expecting the price to do, not eventually, but or not automatically, but eventually price is going to want to take out these equal highs because we have more orders generated. We have double the amount of orders generated in a single area. And this applies for triple equal highs or quadruple, whatever. The more highs we're creating, the more likely price is going to want to attract towards these highs and take them out because these orders keep building up at the same price. So it would be the same exact thing for the downwards examples for equal lows. Equal lows would just be like this. Again, every low that's building up at the same price are magnets, or we're building up more orders in that area, so price is eventually going to want to take out the equal lows or equal highs. So that's a basic overview. We can hop to the charts and look for examples of equal lows and equal highs, but here, let's just do that on the, let's go to the 1 minute. So I'm going to pause and then come back when I find an example. Here's an example that I found on the hourly. So this is relatively recent. So right here, we make a move down. I could draw it with arrows, so it's just easier to visualize. But we make a move down, we make a move up. So the high of that leg is at this wick right here. So let me zoom in. The high of that move is right here. We end up creating another equal high right here. So we can draw out just as a visualization. We could do dollar sign here and dollar sign here. We have orders there, orders there. We have orders at both spots, building up liquidity in that area. Price is going to want to attract towards these areas eventually. So that's what we end up doing. We end up pushing back up and taking out these equal highs. I'm gonna look for a equal low example and come back. All right, right here is an example of relatively equal lows. So these lows do not always have to be perfectly aligned to the exact tick. Sometimes if they are just relatively equal lows, price is going to want to sweep out and take those relatively equal lows. So this is an example of relatively equal lows. And as you can see, price right here ends up taking this out and wicking out lower. Because if you think about how traders are, they're going to have their stop losses down here somewhere. That move wasn't enough to stop them out, but this move was able to stop out all these traders and take out their orders, so big institutions can fill their big orders, basically stopping everyone else out, so they can fill their order. I'll go through one more example, but hopefully this is pretty simple. Here's an example from yesterday, October 1st. Right at market open, we create these relatively equal lows right here. And then again, as the same example as earlier, that wasn't enough to stop the traders out. So the market makes one more move, push lower to stop everyone out. So as you can see, price takes out these relatively equal lows. Again, money sign here, money sign here. Double the amount of orders, double the amount of liquidity. Stronger draw for price to head toward. Takes out both those lows and then pushes back higher. It doesn't always going to push back higher, but in the past two examples, it has. Based off how you trade, you could use that to your advantage. You could also, so there's two ways you could use this. You could use equal lows and highs as you're targeting equal lows. That's how I prefer it because you don't know how every time once the draw is taken, how price is going to react up or down, or if it's going to distribute fast. But when you have these equal lows, it's a lot better, in my opinion, to target to the equal lows or highs and not react after they get taken out. It all depends on the setup, but a lot of times you can just target the equal lows or equal highs as a take profit for your trade because it's such high conviction that price is going to want to head towards there. Because as I was saying earlier, it's double amount of liquidity, double magnets, double price. Price is going to want to push towards those, and it usually pushes towards it pretty fast. So yeah, that's my overall breakdown of equal highs and equal lows. If you want a more depth video and a part 2 of equal highs and equal lows, I can make it. Just drop a comment if you guys do want it. But that is it for today.